Good afternoon, and thank you for joining us for this live YouTube event focused on the impact and the outcome of the recent IRS hearings for the proposed 2704 regulations. My name is Brian Jones, the Chief Operations Officer and Executive Vice President for the National Association of Certified Valuators and Analysts, NACVA, and also the Consultants Training Institute. Joining us on this forum will be Bob Grossman and Peter Agripides, both of whom testified yesterday in Washington, D.C. at the IRS hearings. Bob Grossman has served as a past chair of NACVA's Executive Advisory Board and Standards Board, has been involved in the profession at large for over 25 years, working to pioneer standards, but also teaching credentialing and education programs. Peter Agripides, as a prior board member, also of the NACVA, involved in instructing courses relating to recertification, as well as valuing family limited partnerships. The two gentlemen, with several other volunteer members of NACVA, worked from August up until this past yesterday, preparing the testimony statements that were issued not only to the IRS, but to the membership in the profession. They testified yesterday in DC, and we have an opportunity now to hear from them firsthand what happened there, their insights on the overall testimony, and how it will impact our profession. So Bob and Pete, thanks for joining us.
Hello, Brian. Glad to be here.
So we'll start with you, Bob. Just if you wouldn't mind giving a little bit of background as to these regulations, where they came from, what they were about, and why was there such fervor throughout not only this profession, but many others, as to the proposed regulations and how they would have impact?
Sure, Brian. Well, these regulations in particular have been the result of much angst among IRS professionals looking at the valuation issues related to intrafamily transfers. And the issues really that were encompassed in yesterday's comments at Treasury date all the way back to before 1981 in the release of Revenue Ruling 81-253. But the real crux of the problem, or the bone in the throat of the IRS that is very disturbing to them, is this conceptual idea of massive discounts on asset holding companies, generally structured as family limited partnerships, and the size of these discounts that we have been taking as a valuation in the estate planning community for the last decade and a half, or I guess 2 decades, since Revenue Ruling 93-12. Their feeling is, and it's easy to understand the IRS's position, that where you have a family limited partnership or asset holding company that is indeed holding marketable securities or liquid securities, to simply put that into a entity structure such as a partnership, fractionalize it into controlling and non-controlling interests, and taking substantial discounts when you have that same asset value inside the partnership, it's easy to understand why they were disturbed. I think the problem with these particular regulations is that they've been expected a long time. There was, as I said, Revenue Ruling 93-12, which basically came out in 1993 and did not provide for the allowance of a discount, because a discount is always a facts and circumstances determination. But what it did do is it said that simply by virtue of family attribution, they would not disallow the discounts. So that was the first acknowledgement that attribution was not a problem for the IRS. That really provided the foundational mechanism for the family limited partnership industry, as we all seem to know it and work with it now in the valuation profession since those intervening years. The problem with that is people were so aggressive with the discounts early on that the IRS has taken numerous steps to try to circumvent the application of these discounts with a lot of different 2036 challenges, some other challenges along the way. They had nominal success, so they were able to convince Congress in 1990 to put in Chapter 14, which really envelops Code Section 2701 through 2704. They still felt that wasn't effective enough, and along the way they've attempted to actually expand, if you will, the reach of Chapter 14 through additional mechanisms. That's really where these regulations came out of, and they've been a long time in development. They were expected to be released late last summer into September of 2015. They obviously were held up almost another year until August 2nd of 16. And as is often the case with something this complex, the IRS's attempts to minimize the discounts took on the life of its own and caused a lot of consternation among both estate planners and valuators. Pete?
Yeah, with what Bob said, I mean, you can see how big of an issue this was within the industry with the number of comments that they received. The
Right.
online comment period, which closed on, I believe it was November 2nd. So that ran from August until November, and they received over 9,800 written comments. And not all of those are probably as far-reaching and exhaustive of an analysis that NACFA put forth. Other bodies like the American Bar Association put forth, but they still received 9,800 comments. And going into yesterday's hearing, that was one of the things that I was hoping we would go in there and have somebody say, we're taking these off the table, or we've reviewed all the commentary and here's what we're proposing to do now. But in all reality, I figured that that's probably not going to happen. You only had 4 primary authors of the new regulations, so I figured that it wasn't reasonable for them to have gone through almost 10,000 comments.
Right.
And the other thing is, had they said something, it probably would not have benefited us, because it would probably have been something where they would have, probably ignored a lot of the comments. So it looked from on the surface, it looks like they're taking the comments and really going through each of them.
BVR reported yesterday, they were present and had a very active Twitter feed from the hearings yesterday. And according to their Twitter website, the hearing had an unprecedented number of speakers, 37 in all, the most in anybody's memory. Is that something that they spoke about there, or what was the general perspective on just literally how many individuals were registered to testify?
They did mention it there, and the staff there was pretty strained from the get-go. Literally from the minute that we entered the building and had to go through security, anytime that we walked anywhere in the building, we had to have an IRS escort with us, whether it was the 7th floor to the auditorium hall to go to the actual hearing, to go to the restroom or anything like that. And they were scrambling, and they did mention that.
Wow.
And they also mentioned before we started speaking about the importance of, they were going to really hold everybody to 10 minutes. If you were done or you weren't done when the 10-minute clock was up, you were done.
Mm-hmm.
So yeah, it was an issue.
There was an unprecedented number of people speaking, but also in the audience. Can you talk about that?
Well, there was as Pete has indicated, as you noted yesterday, there's a listing provided to each of us with the listing of speakers and what organizations they were associated with. Those people comprise, as you guys both have said already, 37 total speakers, allotted 10 minutes each. The auditorium that we were in, I know, speaking to Regina Johnson, who was the woman noted in the regulations to contact for an appearance and testifying at this hearing, had told me that the auditorium had 240 seats. And I don't know, what Pete's estimate of that crowd was, but it was substantially greater than 37 people. And I would be surprised if it wasn't somewhere between 100 and 150 people in total that were in the auditorium at the start of the day.
Mm-hmm. Well, let's get into the nuts and bolts of your specific testimony, and then we can talk a bit about some of the other individuals who testified and your perspective on that. From NACVA's position, which both of you contributed to writing that very significant submission to the IRS. What were the key talking points that each of you brought forward in your testimony?
Well, I'll go first. I would mention there was, as you mentioned earlier, Brian, a great many NACFA volunteers that helped put that comment letter together. But there was an exemplary effort made by Rob Leidstadt out of Calabasas, California, as well as Mark Hansen, in addition to Pete and myself. So I want to make sure that they get some acknowledgement for their efforts in that letter. Our primary concerns were appropriately business valuation oriented, and we really didn't get into the statutory requirements with respect to implementation under the tax law per se. Clearly it affects, if you will, the work that we do as valuators, but it wasn't our bailiwick to do that. So my testimony centered around the functional application, if you will, of the term fair market value. We feel as if a great deal of the provisions within the Treasury regs, as they're currently written and proposed, work to basically go against the standard definition of fair market value. So we started that as the main crux. In my comments at the very beginning, we noted that, it's NACFA's primary consideration and concern within the new rules and the new regulations, the way they're currently written, is that they don't really follow business valuation body of knowledge. And that body of knowledge is fundamental to all of the organizations and all the work that all of us do. It also doesn't follow the primary treatises and theoretical, technical information that is available and been available for several decades, nor does it follow prior IRS history in their releases, rulings, and regulations that are final right now. So because of that, we built these arguments, the first of which was, of course, to look at fair market value and go through an analysis of fair market value. So my testimony centered around taking a look at the fair market value determinations in there and where we're at. They do that in several different ways. There's one element of these proposed regulations which talk about a term minimum value. And by minimum value, they simply are talking about referring internally to the value of the underlying assets. In other words, fair market value determinations of all of the assets, and then looking at certain liabilities to decrease them. So instead of looking at the overall value of the operating entity equity interest, they're more functionally looking at the underlying asset composition. And they've been doing that for some time in family limited partnership valuation challenges. But the reality is that's not really a fair market value relationship, minimum value and fair market value. They also, in the context of eliminating fair market value or modifying fair market value as we understand it, is this idea of family attribution. And by virtue of the family attribution, they're basically looking at the ownership of the equity interest as opposed to the equity interest itself. And as we said yesterday, as we testified, and this is in our letter, it has never been intended or understood that the owner or the holder of the equity interest should have some influence on the value of that equity interest. The service continues to see this as a potential area of challenge, and we look at that as a detriment and a challenge to the construct of the term fair market value as we all understand it. The last part is their blanket dismissal of certain discounts through not respecting some of the provisions of the partnership agreements, the lapsing restrictions, the liquidation restrictions, and the fact of the matter is those discounts reflect real economic risk to the holders of those instruments in the proper application, and to completely push that out of the definition of fair market value is to move away from that standard. And so ultimately what we have is we have a circumstance where they are basically trying to redelineate the exact type of value that would be used in a very specific targeted group of taxpayers, those being family business owners. So that was the crux of my testimony. I'll let Pete talk about his testimony, and then one of us will touch on the points that Mark made as well.
Before you do, Pete, I want to first of all thank everyone who's joining us. We've got over 100 viewers, and we have some questions that have been submitted prior to, which we'll direct to Bob and Pete. But if while you're watching you think of any questions, please email your questions to chendac1@nacva.com. If you would like for Bob or Pete to address any of those issues, we would appreciate you getting involved in this conversation as well by submitting your questions, and we'll do the very best we can to get as many of those responded to as possible. So I wanted to interject that before we continue. Pete, you want to get into a bit about your testimony?
Sure. Before I get into the testimony too, I do want to tell you that the speaking notes that Bob, myself, and Mark use are available in their entirety if you go to NACVA's webpage. If you go on their webpage and the top banner, scrolls by, one of them is a link to the webinar that you're on today or the YouTube event that you're on today. And if you go to that, just below the YouTube photo on the page, it has a link to the notes that we use. And then it also has a link, if you haven't already read it, to the full submission that we sent on November 2nd to the IRS. Another thing that was nice about our testimony yesterday, we were the only group out of all the different groups that were there that had 3 individuals present. And with the limited amount of time that we had, we were able to be heard in what we said in our documentation that was sent in on November 2nd. We were able to be heard in its entirety. We went through every single thing. We all had a little bit of time to spare at the end, which was nice because, like I said, we got through everything. I covered basically 4 things. I covered the 6-month put right. I covered minimum value in a little bit more depth. I covered the definition of control, and then I tried to spend the most amount of my time on my conclusion and my recommendations to the IRS. Okay, so let's go through each of those. So the put right, Kathy Hughes spoke up, I don't know, maybe after the 2nd or 3rd presenter, and cleared up some confusion, although we haven't seen it in an official capacity yet. But a lot of us that read over the legalese of 2704, the way the proposed regulations were put out there, we read them to believe that there was a put right. So if you're valuing an interest in any company, you have to assume that that interest can be put or sold back to the company and liquidated within a 6-month period. And that, again, like Bob said just a moment ago, that doesn't reflect market reality. It's not even close. It brings up a host of valuation challenges, least of which is how do you account for the put option on the company's balance sheet? It's also, we were talking a little bit offline yesterday, it's almost like booking that as an unfunded repurchase obligation for an ESOP or something like that. So it gives us a host of problems. The other real issue that we have with it, with the put option, is it doesn't give us a market for comparables. We've seen from several cases that date back decades that tell us the best indication of value for valuing a closely held company is stocks that are traded in the active market. I don't know of any company that has a security with that type of feature, with a 6-month put right that can be put back to the company. Okay, so that's what we talked about with the put rights. And I'm going to say too, with everything that we spoke about, I think Bob was speaker number 16, Mark was 19, and I was number 20. And it was the same testimony that a lot of the other groups had hit. And Bob made a comment to the IRS panel that it'd be harder than watching 2 Hallmark movies back to back, you know, to get up there and just hear this same thing. But as each presenter went up there and echoed the same sentiment, it it gave me more of a sense of calm, because I realized that we had looked at these the same way that other valuation analysts that got up there, that they had looked over these regulations, the same way that the attorney groups had, the same way the lobbying groups had, the same way there were 2 business owners that got up and spoke, the same way the business owners had, the same way 36 of the 37 individuals had. There was one outlier that actually got up there and said that they wanted the regulations to pass. Okay, so
How'd that go over?
yeah, I don't think it went over too well, and I don't know of his safety at this point in time. But so the term minimum value was the next thing that I covered, and I really covered that in the context of, again, minimum value should not replace fair market value. The standard of value has been and always should be for transfer tax valuations for gift and estate fair market value, hypothetical buyer and a hypothetical seller. The term minimum value is really an oxymoron. It does the opposite. It gives you an artificially high value. So I covered that. And then the next was the definition of control. There were a couple of issues there. The first one was aggregating interests that a family member held or that were held through other family members. The second one, that was also a big issue, was they changed the definition of control. They changed the definition of control from over 50% to at least 50%. And anyone that's been through a valuation training course can see the problem with that. If you hold 50%, there's 2 50% shareholders, you're not a controller or a minority. You have a veto power interest. You know, if you hold 50% and you're the largest block, you still don't control. You may have swing vote prerogatives, but you don't control. You need to have over 50%. So again, it was just a hypothetical that they had thrown in. And then finally, I went over my, our recommendations. I'm not going to go over every single recommendation because we had about 8 different recommendations.
Pete, Pete,
Yeah.
if I can interrupt before you do that, I'd just like to mention Pete did acknowledge that he went last, and that's why he delivered the message on the recommendations, intervening. And I'm not able to go through a litany of everything that Mark Hansen spoke of, but he did a very nice job of going through the professional standards. He's done a great deal of work with Mark Cusick in NACFA on the NACFA standards, as well as the other organization standards. He's very familiar with uniform standards of professional appraisal practice. And he went through the conceptual aspects of these limitations and these instructions and these regulations for us as a valuation community to simply dismiss them and in effect turn a closed eye to some of these provisions that are legally binding provisions within the agreement. And he ends up with a discussion so that the audience knows of how many of the valuations we undertake could very well end up being deemed hypothetical valuations because of the hypothetical nature of excluding provisions that we know are there to exist. So the cycle in which we went through was our comments starting, my comments starting with the discussions of fair market value, Mark going through a litany of discussion with respect to the standards and how the standards are impacted by these regulations. And as we issue reports now, again, as a BV community, there's no room for compliance with our standards, with straight up compliance with these rules. And then Pete came in and went through the items that he's discussed, leaving him to this point where Pete offered the recommendations of NACFA as we submitted in our original comment letter.
Mm-hmm.
Yeah, and the first recommendation that we had, and the one that I tried to hit home, I said it 2 times to make them very clear to them, is we asked for complete withdrawal of the proposed regulations. And we didn't ask from the standpoint of, we just don't like them. We think that there are a couple of problems. We asked for them, and I made the point the second time that I mentioned it, to articulate, we believe there are so many issues contained. We had 10 different issues in our comment letter. We viewed there was no way, in our view, to remedy the errors and the problems with the proposed regulations just by fixing a couple of key mistakes. And again, like I just said, that was nothing new. By the time I was done speaking, 19 other people had gone before me and 16 went after. And of the 36 that did not like the regulations, each of the 36 asked for complete withdrawal, and their reasoning was very similar to ours. We just believe that there are so many problems that if this is something that you want to do, we ask that you start from the drawing board again with something that is workable. And then I asked also, if you do start from the drawing board again, give us the chance again to have another comment period.
Right.
Because it will be something hopefully that's completely different.
Right.
And I went through 6 or 8 different items and said, if you don't, here are the major items that need to be remedied in order to make this even considerable or even palatable for us as a valuation organization.
Mm-hmm. As a reminder to Pete's prior comment, you can find Bob and Mark Hansen's and Peter's full statements on nacba.com/YouTube to review their full statements, but also the full statement that was submitted to the IRS. I do have a question from our audience, if you don't mind me sneaking one of these questions in, guys.
No, absolutely.
All right. Probably the most critical one, which is on everyone's mind, and it obviously is very speculative at this point, but what do you perceive as the expected outcome of the hearing?
Well, I'll go first on that. I don't know that anybody has a definitive answer for that. I would say that there's Kathy Hughes, who works for the Office of Tax Policy, an attorney with the IRS, and has been speaking quite a bit. She made a couple of positive comments, which Pete will be able to confirm was tilted towards the positions of the presenters. So I thought that was good. I mean, she understands that there's a lot of clarification that's still required to make these a workable set of rules. So that's a positive.
Mm-hmm.
The problem is, again, with over 9,800 comment letters, 37 speakers, it's hard to imagine a situation where we can have an answer from them in relatively short order. So however that's going to happen, I think a lot of people suspected they would be effective beginning of the year if they went unchanged. I think there's enough change in them now and enough necessary issues identified that it's unlikely that we're going to hear for several months what they're going to do.
Mm-hmm.
I tend to see a situation where I think these are going to be pulled back only because of the number of difficulties in there that were brought to their attention 9,800 different ways, but all the same message over and over again.
Right.
Yeah.
Another question that's come through is, who were the individuals that were actually hearing your testimony? Obviously, they were on behalf of the IRS, but who were they, and do you know what roles they played in this proposed legislation?
Yeah, we do. We were all handed out their information. Do you want to go through that, Pete?
Sure. Yeah, like Bob said, the first one there was Kathy Hughes. She's an attorney and an advisor at the Treasury Department's Office of Tax Policy. And the next was Charlotte Gray, and she was special counsel to the Associate Chief Counsel of the Internal Revenue Service. Next was Leslie H. Finlow. Leslie is, I think, also a senior reviewer to the tax service, to the Internal Revenue Service. And then John McKeon, and John is a senior trial attorney at the Internal Revenue Service. So those were the 4 that were up there. And literally, aside from the 3 comments that Kathy made early on in the morning, we started at 10, it was maybe 10:30, 10:45, when she made her comments. And then one of the other ladies made a few comments when, cutting people off for time that was it. No other commentary was given by the panel. They recorded our testimony, which I found that out later. I was a little worried before because they weren't writing anything down. And I said to Bob and Mark, I said, I don't know if they're even paying attention to us because they're not writing anything down. But they did record it so that they could listen to it and take everything in. But as far as saying anything, that was it.
Okay. We have another question. This individual is asking, I would be particularly interested in the Treasury's question of those testifying, and with a new Treasury Secretary being named by President-elect Trump, whether the Section 2704 proposed regulations are more likely to be tabled at this time.
Yeah, again, that's a great question, but that's one of those questions that there's not a definitive answer for. We did a lot of research, the committee and the task force, including Pete and I, prior to the election, and what we found out was a change in administration usually changes or retards the evolution of these kinds of projects and pulls it back to some degree. We've not seen any indication of that, and I was in fact interested that they held the hearing at all, given the election results. How it's going to go forward, I really don't know. We do know that there was a bill in the lame duck session prior to the election introduced in both the House and a separate bill in the Senate to retract these and take this power out of the hands of the IRS. I would suspect if they tried to basically get these introduced as final regulations, that there would be such an uproar that Congress would get involved and shut them down. That would be my take. Pete?
Yeah, and one of the speakers yesterday from the American Franchise Association touched on that point. And he said that there's actually two bills, and both of them, he said, were gaining steam. They had over 100 and I can't remember, 100 and something, senators supporting it. So that remains to be seen. I mean, the only thing that we have seen from President-elect Trump's tax plan is obviously he's anti-tax. If he could have it his way, he would do away with the estate tax as a whole. That was, I mean, it was one of the bullet points in his tax plan, was to do away with the estate tax as a whole. Can that actually happen? I don't think so. I mean, given the numbers, they're not filibuster proof. They don't have a super majority. So I don't think that could happen. But with something like this, I would think that something like this, like Bob said, if it got passed, I think it would have enough support at that level to be pulled off the table pretty quickly.
Mm-hmm. Another question coming from our viewing audience. What is your take on the state of marketability and minority interest discounts after 2704?
Well, that was one of the things that Kathy Hughes touched on early on. And she had actually said this, I think she was speaking to the Notre Dame Estate Planning Tax Institute or something, and she came out and said, we're not trying to do away with all marketability discounts. And she echoed that sentiment again yesterday. And it's a double-edged sword the way that I view it, because when I first read the document, I could say the same thing. The IRS is not trying to do away with 100% of discounts for lack of control. But they are trying to do away with them in the context of intra-family transfers, which is where we spend most of our time, and estate planning attorneys spend their time devising estate plans. So I don't know if it was a good or bad, but she did say it would be very clear if they updated the regulations that they were not trying to do away with all discounts for lack of control. Discounts for lack of marketability, I think, is a little bit of a different issue. I felt a little bit better when she made the comment about not having the 6-month put option in there, because having that 6-month put option in there would effectively render a discount for lack of marketability moot as well. There are some other ways around it, both tax planning wise and valuation wise, where the value, you can still come up with an effective fair market value without taking quote unquote, but only time will tell from actual regulatory structure what we see coming out of the new proposed regulations.
Another point that you made, and some of the notes that I'm reading from your testimonies, I think this is from you, Pete, that John Porter with Baker Botts, brought up some real-world examples as to how families do not act in accord with one another.
Yeah, that his testimony was interesting. And just a little bit of background on Mr. Porter. He's an attorney with Baker Botts in Houston, Texas. If you've had the joy of reading any of the tax court cases, he litigates a lot of those cases. A lot of big cases that we cite in our materials at NACFA for training and stuff like that. He's an excellent speaker. He goes all over the country and speaks on these topics. And I think he did a really good job of hitting home, and so did some of the other presenters, talking about families don't always get along. And sometimes the worst thing that you can do for your family is go into business with everybody. And that was another sentiment that was echoed along the way. But he covered some different issues. He covered some tax issues, but he also covered some issues and gave us some stories, real world examples of families that just don't get along. And that's one thing that Rob Weinstock that helped us put the document together. He spoke yesterday as well, and he spoke on behalf of his company. He's an interesting practitioner because he's also an attorney. And he got up there and talked about the fact that, he said, I have made the majority of my living over the years from families suing each other.
Wow. And
he gave the example, he's from Calabasas, California. He said there's a very famous family from Calabasas that has intrafamily issues, and it was the Kardashians. And he kind of made it a little lighthearted, but it hit home that families don't always get along. And a lot of the things that we have in our operating agreements for a family limited partnership, for bylaws for a company, are in there. They're in there to protect against divorce. They're in there to protect against the interest being diluted by a creditor suing or a sibling suing or something like that, somebody trying to liquidate their interest.
What was some of the comments that were made by the representatives from the AICPA, Michelle Gallagher and Justin Ransom, some of the comments that they made towards these regs?
Well, actually the AICPA was never able to get themselves in a position to issue a comment letter, and they offered on several times throughout the two presentations. They had two speakers on their behalf, someone from Ernst & Young and Michelle Gallagher. I spoke to Michelle on break, and she was very complimentary of the NACFA speakers, also the NACFA comment letter, and how closely it aligned with their positions. Michelle in particular spent a great deal of time talking about business valuation issues in her 10 minutes, and she focused again on primarily on the fair market value discussions, and the term fair market value being basically reconstructed under these particular rules.
Mm-hmm. And the AICPA, the ASA, they partnered with an association in preparing their statements.
Yeah.
What was the farm?
Yeah, farm group. It was maybe.
What was your perspective from their input on these regs?
It was very similar. They covered a lot of the same issues. They asked for withdrawal. They covered a lot of the different valuation issues. They talked about family discord, families not getting along. And I think it might have been them. It was either them or whoever went right after them, but there were a couple of different presenters that hit home how much this would affect family businesses. and how many people across the country are employed by family businesses. And I believe that it was them that kind of led into that. One person gave a statistic that 66% of the US workforce is employed by small business, and somebody else gave a statistic of 72%, but it's a very large percentage. And then you had, following up on that sentiment, you had two business owners. There was an older lady that really got a lot of attention from both the panel and everybody watching. The whole room just went quiet when she got up there. She opened it up very eloquently and very poignant. She said, "I guess I'm the one that you guys are all talking about here."
Wow, yeah.
She was a business owner to get up there. And she talked about her family had a motel in Jackson Hole, Wyoming. And when she started it, she was 28 years old. She started it with her mother and father. It was all of their life savings, and had a few employees to begin with. They employ 100 people now. And she said, if this was to be valued under these rules and we weren't able to take discounts, we may have to sell the business because property prices are so high in Teton County, Wyoming. And she said, the most likely buyer to come in there and buy that would be a private equity fund or something like that. She said, Jackson Hole is just awash in private equity money. She said, that's good for investment, but they don't have the same community involvement that we have. And then later, towards the end of the day, was the fourth generation owner of White Castle, the burger company. And his plea to the panel was just give business owners something that's easy in terms of a tax, something that we can follow, something that we can anticipate. So the ASA kind of led into the discussion from the two business owners.
Yeah, I think, Brian, the interesting thing about the speakers is the sheer diversity of the speaker group. I mean, we had the National Auto Dealers Association represented there. We also had the Texas Society of CPAs. We had business people, as Peter's just alluded to. We had, of course, valuators like us, representatives by ASA and AICPA. But then we also had the National Cattlemen's Beef Association. We had the S Corporation Association. I mean, what we saw there yesterday was a great response, if you will, to a problematic set of rules promulgated by the government that really works against the betterment of small businesses. And I think it had to come out very strong at the end of the day. 37 speakers. I mean, there was a constant message through all of them, but one, as Pete alluded to. So I think it obviously shows the breadth of these rules, the reach of these rules, and the dismay that the taxpayer and practitioner community has with the way the rules are currently written.
Well, I have to believe that of the audience watching this discussion with you now are very involved in this area in their practice. And both of you obviously are specialists in this area. What would be your recommendation, particularly going now into tax season, advising your clients to give some tools or some advice as to how to deal with clients in this environment with nothing yet being really determined? What are some good practices to consider?
Well, what I've heard since August, since the proposed regulations can't come out, I mean, I do mostly gift and estate tax valuations, but I'm the last person in that advisory group that gets brought in. Usually it's the attorney first, and then their CPA, and then they, get the valuator in there. But a lot of the attorneys that I have worked with have just echoed the sentiment of, look, just do it now while you know what you get. You know that you at least have the opportunity to file a discount or a valuation with a discount. And it could still be audited. There could still be issues with it that the IRS brings up. But you're not fighting an uphill battle of how do we somehow get a more favorable value once something like this goes final. And Bob and I were talking yesterday about what's going on in our practices, and kind of what we've seen is once the election was over, the stream kind of slowed a little bit, because I think those in the business community feel that this isn't really a pressing issue now that President-elect Trump has been elected. I think it's something that still, if you're on the sidelines and it's something you've been contemplating, get it done. Go out there, talk to your referral sources, talk to the attorneys that you work with, make sure that they're educated on this, which I'm sure that they are, and stir up some business while you still can take the discounts.
Mm-hmm.
Yeah, I think I kind of agree with Pete. I think the issue, though, is as a practitioner group, we have to be careful not to overstep our bounds. I mean, the law is as it is today. It could change quickly. But I suspect, as he does, that this is an issue that has garnered much less of a snowball effect now that the election is over. And I would be surprised to see these regs finalized in anything close to its current format. Now, what it turns out to be, I don't know. And the pain today is better than the pain you don't know. So as Pete suggests, I mean, if you can get work done under the current regime, the current rules, it's probably a better outcome for us as a practitioner group. I also would caution people that I think, if you're of the ilk, as Pete and I are, as NACFA is, that we would like to see these regulations withdrawn, you still can't bet on that until we know definitively. So you have to be careful the way you communicate things like that to the clients who are passing up opportunities now to capitalize on discounts and so forth, on the bet that these rules won't go into place at the end.
So to conclude, first of all, I want to say thank you to both of you, also to Mark Hansen and Rob Weinstock and the other members of NACVA's Legislative Action Committee who worked for hours and hours since August putting together this formal and very technical response, which led to these testimonies by these four gentlemen on behalf of NACVA and the valuation session. Any last comments or recommendations from either of you?
Yeah, I think one that we didn't cover that just popped into my head. There was in our comments and echoed throughout everybody else's comments was the topic of the fact that this should not apply to operating companies. It should only apply to holding companies. And Bob and I were kind of talking during one of the speeches anyway that even if you're valuing a holding company, a family limited partnership or something like that, and you look to section 2036 of the code, for that to be a bona fide business, for it to be an actual business under that section of the code, you could probably still make the argument, or at least take the position that that's still an operating company, even though it does tend to hold assets. But everybody wants this removed from the context of operating companies. And that's what was one of the biggest surprises in August when this came out, was everybody thought prior to this, since about 2009, that we kind of knew it was coming, and we all thought we're trying to do away with discounts for family limited partnerships for the traditional holding type company, not operating company. So that was surprising.
I think what it shows is what my takeaway from all of this is not the technical issues per se. I mean, they are what they are, and we've responded. But I think it shows the strength of the taxpayer community, the practitioner community, to influence legislation and regulations simply by getting involved, by being a participant instead of sitting on the sidelines and simply taking the punch to the nose. I think NACFA's response has been exemplary. I think it was brought forward, it brought to the forefront yesterday more than at any time since this started, that NACFA is an industry leader in dealing with this particular issue. And we received a lot of compliments and discussions on that. So
right.
I think that's what I've learned from this. I've been in tax and valuation for 35 years. I've never been part of a process like this, but I think it shows that there is a voice out there for us as long as we do it in a unified way.
Yeah, absolutely. The other thing I want to bring up there is when we wrote our submission letter to the IRS, We also wrote something for the community at large, for the valuation industry at large. And it's a letter, it's a formatted letter that at least gives you a start or a template that you can doctor it up, put it on your letterhead or whatever, and send it to your Congress people in your area to voice your concern. Because, you know, when this came out, I literally took a lot of sleep thinking about it. What are the implications, and thinking about the worst case scenario. And I realized the only thing I can do is I can do what I can control, and that's to go and at least fight for it.
Mm-hmm.
You know, so I would suggest to everybody that's on this call, and if you know other practitioners in your area, in your state chapter, it's not too late to ask them, even though it looks like we got some traction yesterday, and we got some traction with 9,800 people submitting written documentation. But take the letter, take the time. We've done a lot of the writing for you, and send it to your congressperson. You can print it in a PDF, go to your congressperson's webpage, and upload it. We had conversations with some Congress people, you know, where some of the different people in the legislative committee were located, and they're pretty easy to get a hold of. You know, at least somebody on their staff will return your call. So I would suggest, again, go find that letter. It's on NACVA's webpage. Send the letter, and I would suggest sending the letter with NACVA's comment letter, the entire comment.
Yeah, the resources that Pete is referring to are again on the landing page, nacva.com/YouTube. They're also from the home page. In the rotating sliders is an IRC 2704 banner. If you click that banner, it will take you to the resources as well. To conclude, NACVA's Executive Advisory Board established a Legislative Action Committee in the recent months to respond to these kinds of issues. We appreciate the members who have supported this particular regulation proposed from the IRS. Next month, we will host a YouTube live event that will dive into something that's becoming more publicly aware, and that is the Certified in Entity and Intangible Valuations credential that is being promoted and supported by the ASA, AICPA, and RICS. There's been quite a lot of news in the Wall Street Journal, also through various social media and our trade publications, as to this new certification that's coming out and how it will impact the valuation profession. So in the month of January, we will host another YouTube live event where we will speak about those issues and how it will impact our profession. But for today, we thank you all for joining us. Have a happy holiday season. Thank you, Bob and Pete, as well. And NACVA signing off for now. Peace.